Welcome back. Today we are diving deep into a pretty hefty stack of financial data. We've got the third quarter 2025 results for U.S. Bancorp hot off the press. Our mission here is simple. Cut through all the jargon, all the press release spin, and give you the key takeaways. How is one of the country's biggest banks actually performing right now? What's driving their results? We're going to focus on three main things today. Profitability, are the gains real? Revenue, how diverse and resilient is it? And critically, balance sheet health, credit quality. So just looking at the headline numbers, they were pretty impressive. Diluted earnings per common share EPS hit $1.22.
Yeah, and that's up 18.4% from last year. That's a solid jump.
Right, and net revenue, a record $7.329 billion.
It is. But what's really fascinating to me isn't just the big numbers themselves, it's the consistency. You can really see them making tangible progress, measurable progress against the medium-term targets they set out. They're executing their strategy, and it's working.
Okay, so where should we start to understand why this quarter feels significant?
I think we need to zero in on two key internal factors. First, operational efficiency, how well are they managing costs? And second, the strength of their revenue mix. How diversified are they?
Okay, let's start with efficiency then. Every company wants to control costs, obviously, while growing sales. But in banking, there's that specific metric everyone watches, right?
That's right, the efficiency ratio. It's actually a pretty simple concept, but powerful. It's basically total non-interest expenses divided by net revenue. Lower is better. Tells you how much it costs to make a dollar.
And their result this quarter?
Improved significantly. Came in at 57.2%.
57.2%. Now, that sounds low, but you need context, right? Where were they before?
Exactly. Context is everything. Just 1 year ago, in 3Q24, they were at 60.2%.
Wow. So dropping 3 full percentage points in a year.
Yeah, it's a big move. And crucially, it lands them right smack in their target range. They were aiming for the mid to high 50s. Hitting that really validates their cost management approach. It shows it's delivering.
So how did they manage that? Did they just slash budgets everywhere, or was it more targeted?
Definitely more targeted. Smarter, I'd say. They achieved something called adjusted positive operating leverage.
Okay, finance jargon alert. Break that down.
Fair enough. It was 530 basis points year over year. Basically, it just means their revenue grew way faster than their expenses did. Think about it like this. For every dollar they spent a bit more on operations, they brought in much more than $1 in new revenue. That's the positive leverage.
Got it. So that huge gap suggests it wasn't just about cutting costs, but maybe shifting where they spent money.
Precisely. You nailed it. Their total non-interest expense line was basically flat. Actually, it decreased a tiny bit, 0.2% year over year. But when you dig into the details, you see the strategy. They cut costs in areas like compensation, maybe some real estate, occupancy.
Okay.
But they didn't just pocket the savings. They immediately reinvested that money, put it into technology upgrades, into marketing, strategic stuff.
That's self-funded growth right there.
Exactly. And you see that discipline flowing straight through to the metrics investors really focus on.
Like return on average assets, ROA. That improved quite a bit, up to 1.17%.
It did. But let's focus on the really key one for banks. Return on tangible common equity, ROTCE.
Right, ROTCE. That rose to 18.6% this quarter.
Which is bang in line with their target of the high teens.
Okay, quick detour. Why tangible common equity? Why is that specific measure important here? What does it strip out?
Good question. It's an essential distinction. ROTCE takes out the intangible stuff from the equity base. Things like goodwill from past acquisitions. That stuff might inflate the balance sheet, but it doesn't necessarily generate cash flow today.
Right.
So a high ROTCE, like this 18.6%, tells you they're generating really strong returns on the core, physical, tangible capital they actually deploy in the business.
So it proves the operational improvements are yielding real, high-quality returns.
Exactly. It's not just accounting fluff. Okay, so efficiency's strong, but, efficiency alone doesn't guarantee success long-term, especially for a bank. You absolutely need strong, diverse revenue streams, ones that aren't just tied to the ups and downs of interest rates.
And this is where U.S. Bancorp has a bit of a reputation, right, as being strong in fees.
They do, and the numbers back it up. Fee income makes up roughly 42% of their total net revenue this quarter.
42%. That's a significant buffer against rate swings.
It really is. And look at the growth. Total fee revenue was up 9.5% compared to last year.
Wow, 9.5%. That's huge.
Right.
Especially when their target was, what, mid-single digits?
Exactly. They blew past their mid-single digits target.
So where did that growth actually come from? Let's break it down.
Sure. Well, some of the traditional areas were very solid. Trust and investment management fees, for example, up 9.4%. That's $730 million right there.
Okay.
Capital markets revenue was also strong, up 9.3%, hit $434 million. They mentioned corporate bond underwriting and syndication driving that.
Makes sense. What about payments? That's usually a big engine for bank tech and fees.
It is. Total payments revenue grew 2.7% year over year. Solid, if not spectacular. But within that, merchant processing, handling card payments for businesses, that was up a healthier 5.2%, reaching $463 million.
And you can see their tech partnerships starting to pay off there too, presumably.
I think so. They highlighted a couple of things. Elavon, their payment processor, expanded its partnership with Woo, that's the e-commerce platform, into North America. Easier for merchants.
Right.
And their Elon Card Network, which provides cards for smaller banks and credit unions, crossed 1,300 partners. That builds a long-term foundation for fees.
Okay, but let's get to the number that really just jumped off the page for me. The aha moment, maybe. Impact finance revenue, up an incredible 55.4% year over year, hitting $101 million. That's massive growth.
That is absolutely the spotlight area this quarter. And it tells a really interesting story about where banking might be heading. So impact finance, this covers things like affordable housing projects, environmental finance, think green energy, and supporting development in low to moderate income communities, LMI.
Okay, so purpose-driven finance, essentially.
Pretty much. And this huge jump wasn't just slow organic growth. They specifically mentioned getting a boost from gaining market share in California and also some legislative changes there that kind of pulled forward demand for these types of financing deals.
Fascinating. So you've got this high-growth, high-margin business now coming from areas focused on social and environmental impact. And they're smart enough to leverage specific state needs, regulations, to capture that revenue.
Exactly. And it's not just a one-off blip. The source material notes this niche has a strong long-term potential. They're talking a 17% compound annual growth rate, CAGR.
That shows real strategic diversification. It's not just relying on the same old stuff. All right, let's shift gears. We've talked efficiency, we've talked revenue. Let's look at the foundations, the balance sheet, deposits, loans, credit quality. Average total deposits look pretty stable, up just 0.6% year over year. Seems kind of modest.
Yeah, the headline number is modest, but the mix shift underneath tells a really important story about what customers are doing. Non-interest-bearing deposits, basically. Checking accounts earning zero. They actually dipped slightly, down 1.3%.
Okay.
But savings accounts, they saw this massive surge, up 70%. 70% year over year.
Whoa, 70.
Yep. And that huge inflow drove the overall total savings deposits up 1.6%.
So people are clearly chasing yield, moving cash out of checking into savings to get those higher interest rates.
Absolutely. It's rational customer behavior in this rate environment, and the bank seems to be capturing that shift.
Okay, what about the other side, the loan book?
Average total loans grew 1.4% year over year, or 2.8% if you adjust for some loan sales they did.
And that loan growth, maybe the mix, helped their net interest margin.
It did. NIM improved 9 basis points just from the previous quarter, reaching 2.75%.
9 basis points, so 0.09%. A decent quarterly improvement?
It is, and the loan mix is key here. Commercial loans, business loans grew quite strongly, up 9.5% year over year. But, and this is an important but, commercial real estate loans, CRE, actually declined, down 6.2% year over year.
Declined. Okay, wait. You mentioned earlier that overall credit quality actually improved, but now you're flagging a decline in CRE loans, and they mentioned loan workout activities. Is this a trouble spot they're actively managing down?
That's exactly the nuance here. It's a crucial point. The materials are very clear. The problems in CRE, the non-performing loans, they continue to be concentrated specifically in the office portfolio.
The office sector, still struggling.
Still struggling. So while the broader economy and their overall commercial loan book seems to be holding up okay, that traditional office space remains a major headache. They are actively trying to reduce their exposure there through these workouts and getting loans paid off, de-risking.
Okay, so if we sort of mentally cordon off that office CRE stress, how does the overall credit picture look?
Stepping back, yes, overall credit quality metrics did improve despite that specific issue. The net charge-off ratio, that's the percentage of loans they actually expect to lose it, improved slightly, down to 0.56%. That's 4 basis points better than last year.
Okay.
We saw commercial loan losses improve, and credit cards, which can be volatile, saw a seasonal improvement from the prior quarter. Their NCO ratio dropped to 3.73%. And the non-performing assets ratio, NPAs, also ticked down, generally positive trends.
But they are still building reserves, putting money aside for potential future losses.
Mhm.
Why, if things look okay now?
Ah, exactly. Prudent management. They added $35 million to their allowance for credit losses this quarter. Now, this wasn't driven by current bad loans spiking. It's because of that forward-looking accounting standard, CECL, current expected credit losses.
Right, the crystal ball calculation.
Kind of, yeah. Their CECL model is built on macroeconomic forecasts. And right now, their model assumes a potential peak unemployment rate down the road of 5.9%.
So even though charge-offs are okay now, they're setting aside money in case the economy weakens and unemployment hits, say, 5.9%.
Precisely. It's cautious, forward-looking provisioning based on their economic outlook, necessary prudence even when current metrics are behaving.
Okay, so looking ahead, it really feels like the focus is just on executing that strategy, hitting those medium-term goals we talked about, using the capital strength they've built up. We even saw some outside validation this quarter, didn't we?
We did. Moody's, the rating agency, revised U.S. Bancorp's outlook, moved it from negative up to stable. That's a pretty significant vote of confidence. And they cited exactly what we've been discussing, the strong revenue diversification and their solid balance sheet. It all ties together.
And on the strategy front, they're pushing ahead with tech, particularly for businesses, it seems.
Yeah, they highlighted launching new embedded digital tools for small business clients. Things like U.S. Bank Payroll and U.S. Bank Bill Pay for Business.
Embedded meaning.
Yeah.
Built right into their main online banking, not a separate app.
Exactly, weaving cash flow management, payroll, bill pay right into the core platform where businesses already are, making it seamless.
Smart. And they're also dipping their toes into the digital asset space.
They are, but in a very specific bank-like way. They were chosen to provide custody services, basically, safeguarding for the reserves that back up payment stablecoins issued by Anchorage Digital Bank.
Okay, so leveraging their traditional strengths as a custodian, but applying it to this new digital world.
Precisely. It shows they're willing to adapt and play a role in the evolving financial landscape, using their existing core competencies.
Right, before we wrap this up, let's touch on the forward guidance. What are they telling us to expect for the fourth quarter, the end of 2025?
Okay, management's outlook. They expect net interest income, the NII, to be relatively stable compared to this strong third quarter, so holding steady there. Total fee revenue, they're projecting it to remain high. Around $3.0 billion is the guidance, so continued strength on the fee side.
And expenses. Are they still investing?
Seems so. They project total non-interest expense to tick up slightly, maybe 1% to 1.5% compared to Q3, which again reinforces that theme of ongoing strategic investment, likely in that tech and marketing we discussed.
Makes sense. And finally, capital. How are they positioned?
Very strong. The CET1 capital ratio, that's the core measure of a bank's financial cushion against shocks, it's robust at 10.9%. That's up 40 basis points from last year, well above the regulatory minimums. Gives them flexibility. And they actually completed $100 million in share buybacks during the quarter, too, signaling confidence. Hashtag tag.outro.
Okay, so wrapping this all up, the big picture takeaway seems to be a story of really disciplined execution, wouldn't you say? They managed costs smartly to boost efficiency, hit their targets, which drove higher returns. They delivered really strong fee revenue growth thanks to the diversification strategy, especially in those surprising areas like impact finance. And all this while maintaining pretty sound credit quality overall, even improving it while still cautiously building reserves for whatever the future might hold.
I think that's a fair summary. Disciplined execution is the key phrase. But it does leave us with a pretty critical question as we look ahead, maybe into next year. You see this really strong growth in these specialized, maybe higher margin fee areas, impact finance, capital markets, great. But how do banks, not just U.S. Bancorp, but how do they maintain that kind of high growth trajectory while also balancing the sort of regulatory and core business need to focus on low-risk things like gathering consumer deposits, there's a tension there. And maybe more pointedly, what risks does that ongoing deliberate decline we saw in commercial real estate loans, especially with that known concentration in the office sector? What does that signal for the bank's balance sheet composition and its risk profile down the road? Managing that CRE exposure, that's definitely something to keep watching closely.
A very insightful question to leave our listeners with. Balancing growth ambitions with core stability and managing legacy risks.
Excellent point. Well, thank you again for breaking down all this complexity for us. Really appreciate the insights. And thank you for tuning in. We'll catch you on the next deep dive.